when identifying like between like trending cycles and market maker cycles, um, how would you be able to know like for a trending cycle when the lower high is actually the lower high? Because sometimes I might see something and I might see it go up, and then I'm like, okay, that's the higher high, and so I'm not thinking anything to go up any higher, and then it does go up higher. I'm like, maybe that isn't the higher high or the lower high.
Well, I think you got to look at specifically. So you're talking about weekly cycles. So you have to look at specifically like Monday, Tuesday, because Monday, Tuesday is going to give you a big indication of what could happen the rest of the week. So if you're looking at, let me break this down to a 1 hour chart real quick. All right. So, I mean, here you can see Monday, Sunday, Monday, Tuesday. You see how Wednesday, it continues to go down and breaks Tuesday's low. If you get, I think to identify a trending cycle is if prices go lower on Tuesday, or let's say prices go higher on Wednesday, that should be a good indication that you're going to be in a trending cycle for that specific week.
But when do you know when the lower high is actually the lower high and it's not going to go up a little bit higher? Like how do you know when it fully stopped?
You would know by the end of the Tuesday going into Wednesday, because you have to think about what are the other two cycles, which is accumulation, right? Which it wouldn't really be in the conversation, or market maker cycle. What happens on a market maker cycle? You have a false move on Tuesday and then a quick reversal on Wednesday. But on Tuesday of that market maker cycle, you have to have a full move in that one direction. That's what makes the difference between a trending cycle and a market maker cycle, right? Is on a trending cycle, you may not have that full day of movement in one direction on Tuesday. On a market maker cycle, you do. But what I would tell you is instead of trying to figure out the weekly cycles, just follow from peak formation to peak formation, because it'd just be a lot easier for you. This is why I don't talk about it in the new class.
Okay.
Because I'm just trying to make it as simple as possible. Literally, I'm just trying to make it as simple as possible. So that's why I don't even talk about it in the regular 12 weeks.
Okay, I've got a question, Mark.
Yeah.
So if price has gone more than 3 times ADR in one direction, however, on the daily time frame, it still hasn't reached where like we're pretty sure it's going to. Should I continue to look for sells or
you have to look for sells. Yeah, you have to look for sells until it gives you a peak formation low to form, right?
Right, I understand that, but I mean, I meant to say, like, should I stop trading at 3 times ADR or continue looking for sells?
I think that if you're in a situation to where you're literally like this, like Euro NZD right now, you're like out in the middle of nowhere, like there's no reason for you to look for buys, because the buy side is going to be very short-lived. You know what I mean? So you should not be looking for buys at all. You should keep going. Continue to look for sells, continue to sell until they give you a structure, an actual real good structure point. And that's not going to happen until you get to a larger time frame structure point anyways. You know? So in all these pairs right now, all these Euro pairs that are, out in the middle of nowhere, you're going to get peak formation lows, but those peak formation lows should not last. They should be small peak formation lows. Like if you go down to the 1 hour time frame, like how I have them marked out right now, they're really small. They're basically like 1 day, 1 day and a half, maybe, you know what I mean? But then you just keep selling. There's no point in looking for and trying to pick for bottoms. You know what I mean? Like that's where you're going to lose a lot of trades when you try to pick tops and bottoms. Like your job is not to pick tops and bottoms. Your job is to identify tops and bottoms once they are formed and then trade away from them.
That makes perfect sense.
You know? So don't try to be the one that picks tops and bottoms. I was trying to do that for the longest time. It doesn't work. You're gonna get you'll get one or two and you'll feel like God, but then 50 of them will lose. So don't try to do that. Just wait for them to form first and then trade away from them, you know, is really what you're trying to do. But you also have to understand that if on the higher time frame like the daily, if there's a big sell-off happening and there's literally no structure to them, or there's no structure anywhere near where price created that peak formation, very likely that peak formation won't hold. Those peak formations won't hold. They're out in the middle of nowhere, so there's no reason for them to hold. They're just doing it because they can't continue to drop the market. It's the only reason why they have it.
Gotcha. That just made a lot of things click. I appreciate it, Mark.
Yeah, no worries.
Hey, Mark, so are we like, for example, like now, right? We'll only be looking for sales on the daily until it reaches structure. Like we wouldn't go to like the 4 hour. Because I
Well,
see like sometimes you go to the 4 hour and sometimes you go to like the daily.
yeah, mostly I use just the daily, right? Because it's just a simpler way to view it. But I mean, the daily time frame. The only reason I use the daily time frame is to tell me where price is likely to go, right? Because if you look at a 4 hour time frame and a daily time frame, the structure points are going to be a little bit different, right? You're going to get sooner structure points on a 4 hour time frame, but the actual important ones are going to be on the daily, weekly, and monthly charts.
Okay.
So I much rather just look at the daily and just look at the important ones that matter. So that's why I look at the daily only for the majority of the time, is because I just want to look at where are the major structure points that I know price will go to, and how many times am I going to reset to get there, basically, based on what's the pip count from where I'm at right now. There's a couple things that I want to answer just so everybody hears it, that I got from email from someone else, that I figured I'd answer them here so they can see it in the recap. So the question is, regarding stop losses. How does one determine where to place the stop loss? Are you using a pip count or previous structure or something else? So when it comes to determining the placement of the stop loss, it's very simply depending on what the structure is of the actual pattern that you're trading. So, example, this is a type 3 here. So this would be like a type 3, type 4, actually type 4 pattern, right? Where would the stop loss go on this pattern here? Well, what is the entry pattern that you're using on this, which would be basically the pattern being a type 4, and then the actual like pattern itself is railroad tracks, right? So if your entry is right after the railroad tracks, well, your stop loss is going to go above the railroad track, right? Now, in this case, because you have the 50 there, you'd want to have your stop loss above the 50, because the 50 helps protect basically protects you. It's like a barrier. It's like a line that helps protect you. And then the only other question you got to ask yourself is, okay, if I do that, can I go out 2 times ADR, and does it still make sense for that trade to happen? So in this case, it's 21 to 44. You ended up getting about 56 pips. If you held it long enough, you ended up almost at 100. On this one, the previous day here, this was what, a type 1? And so this is the first leg here. This is the second leg right here. You would hope to be able to get a pullback. You don't get a pullback, right? So you measure this out. From here is what, 34 pips. You have to go all the way to the high, which is 35 pips or so. And then where would you take this to for a 2-to-1? You'd have to go 71 pips out. Is there anything down here? If you look to the left, there's nothing here for you to go off of. So you got to ask yourself, are you willing to risk 34 pips to try to make this trade work? In this case, this trade did work, but in every case, it's probably not always going to work because you're risking way more pips than normal, especially on a pair like Euro CAD. Right. So on this one, you would want to wait for a pullback. Yes, exactly. You would want to wait for a pullback, right? Because a pullback just gives you a better entry. And so if you were to get a pullback, now instead of 34 pips, you're looking at 25. And to me, that's still a lot for this specific pair, right? So the majority of the pairs you're going to be looking at is maybe 20 pips tops for the majority of the pairs, right? So you're going to be looking at the only pairs that would require a higher stop loss would be the NZD pair. So Euro NZD, Euro AUD, Pound NZD, Pound AUD, gold, right? So those pairs and maybe some JPY pairs, you can go a little bit higher, maybe 25 pips on JPY pairs. So Euro JPY and Pound JPY. But the other ones, you're going to be, pretty much between 15 to 20 pips. So to answer the question of how does one determine where to place the stop loss, it really depends on the actual setup itself. On the second leg, where are you getting the setup on the second leg? Is it going to give you enough pips, for you to actually enter the trade? So like here's a type 4 that gave you same thing, a railroad track, right, as the entry point. And so right after the railroad track is your entry on this. And so you could see like this one is 23 pips or so, 24 pips. This is within the range because you're trading Euro AUD that you're okay with it. And I mean, 2-to-1 on this is literally like this. So you're not asking for a lot here. You know what I mean? So determining where you put the stop loss is very simple. The stop loss should go above the structure where you're entering. But it's got to be within the range that you allow yourself for for the specific trade setup or for the specific pair. So these are stop losses are 18, but again, they're going above the entry candle. Basically, it's almost above the entry candle or above the structure. So if you're trading a type 1, then the stop loss is going to go above the first and second legs of the type 1. Same thing of type 2 trades, you're going to go above the first and second legs of the type 2s. Type 3, same thing, above the structure of where you're entering at. The only question becomes is when you put this on the chart, does it allow you to get a viable trade according to if you were to put your stop loss where it goes or where it should go? If you don't get, like, let's say this one's a type 3. If you don't get this pullback here that allows you some leeway, you're still within range of this 19 pips here. Let's say if this was not 19 pip. Let's say if it was 40 pips, would that be viable for you to actually take that trade? The answer would probably be no. But if you get the pullback, right, and the pullback allows you to now save 10, 15 pips because of it, then now that becomes a more viable trade for you to actually take. As far as how far up above it, I mean, you could put it, you're basically now talking about the spread is really what it comes down to. So you could do, the simplest thing that you could do is what's the spread on the pair that you're trading? Is it 3 pips, 4 pips, 5 pips? Just make it enough to cover that. If that's, you know what I'm saying? So if you're trading Euro USD, the spread on that is less than a pip most of the time. If you're trading Euro AUD, the spread is, you know, probably a little bit higher than that, maybe 5, 6, 7 pips. So it just depends. But typically for me, like I just put it above the candle, you know, maybe a couple pips above the candle. That's it. I don't really think about it too much because I'm thinking of the fact that if I'm right, I'm gonna be right, and if I'm wrong, I was just wrong. It doesn't matter if I put it 10 pips higher than that. You know what I'm saying? If I'm wrong in a direction, I'm gonna be wrong no matter what. The next question to that was, what pairs produce the most type 1s, 2s, and 3s and 4s? I mean, they all produce, every pair produces the setups. It's just a question of what pair produces what specific setup. The only way to find that out is through backtesting. That's it. There's no other way to find out which pair produces how many of what specific type. The only way to do that is through backtesting. I know that that pound USD will probably produce more type 1s than any other pair, just because I know a student that backtested it and showed me the data for it, because it was comparing pound USD and pound NZD and which one was, you know, able to produce more type 1s. Well, we know that pound USD actually produced 3 times more type 1s than pound NZD. But the only way to get those specific numbers is honestly to do the back testing and to figure out which, you got to figure out which of the setups do you really like. If you like type 1s, then guess what? You're going to go through all the different pairs, right? And go, you don't have to go a year. You can go maybe 6 months and just count how many type 1s produced. And you don't have to even replay the charts to do that. You can just literally go back to the beginning of the year and just literally start counting, start looking at the setups and be like, okay, this is type 1, that's 1, 2, 3, 4, 5, go all the way down. So you're not replaying the charts, you're just going back through the charts to count them. And that'll tell you the answer to that question specifically. But now you'll be able to produce a lot better trades because the pairs specifically that you're trading are meant for, you know, that specific type of setup. The other question was, what's your personal favorite 5 pairs to trade? Essentially, Euro NZD, Euro AUD, Pound NZD, Pound AUD, and Pound USD. That's it. And the last question for that email was, do we offer signals? No, we don't offer signals. The next question was about the TDI, and I have to stop the screen sharing real quick just so I can bring it up, because there's an example attached to it that I want everybody to look at. All right, so this is the example. And so the question is, look at the example below the TDI sentiment that goes down and below the 50 line, but my directional bias is going up. How do you interpret the TDI in the situation? Well, if you're going up, that means that you're looking for buys. So the only thing that you're worried about looking for on the TDI is for this green line to be at the bottom half of the TDI. Like, that's the only real thing that I care about. when I'm looking for this. Because remember, the TDI that I'm using is I'm just using it for as a sense of confirmation, right? And so this allows me to get good confirmations because I know the TDI is also bottoming out as well. So if I'm looking for a type 1, let's say, I should be having the TDI all the way down here, and that's the only thing that I care about. I don't care about this yellow line being here or anything. That just doesn't matter to me. The only thing I care about is the TDI agreeing with me to help me confirm that, yeah, we're hitting the bottom.
When you're trading and you're waiting for a pullback, what type of order do you place to get into the trade? Is it like a market order, or do you set a limit order and wait for it to hit it?
So that really depends on you, actually, because if you are the type of person or trader that wants to get that type of perfect entry, then you would actually use a limit order, because you're only wanting to enter the trade if you're given the entry that you specifically want. And so let's say a good example for that would be is if you're trading, let's say, Euro USD, and the only way that you can get into the trade is if you get a pullback of like maybe 20 pips, because right now if you don't get a pullback, the trade is too big of a risk for you. So if you have to get that, let's say 15, 20 pip pullback to get into the trade, that might be a good direction to use a limit order and put it right at your entry point where you're like, okay, this, if it were to come back to this point, that would make sense for me to enter the trade. If your stop loss without the pullback is within the range of your stop loss, like within that 15 pip range, then honestly, it wouldn't matter if you get a pullback anyways, because you could still enter the trade. So at that point, a market order would definitely be way more, faster and beneficial for you.
That answered it. Thank you.
Yep. Who else had a question? If a second leg is higher than the first, then a third leg happens. And it's even higher. It's not an M, right? Yeah, so an M, right, has only 2 legs, right? So whenever you're getting third legs that are higher than the second, no, that wouldn't be a pattern. No, you're fine, Matthew. If you're getting the second leg, and let's just say we're forming an M, and the second leg here, let me go to a whiteboard real quick. So if we're trading an M, right, and the M that you're getting is something like this, right? This part here has to be 45 minutes or less for it to be a valid, to me, for it to be a valid M.
What if it's like a star pattern with multiple stars? So it's like an hour instead of 45 minutes.
If you're getting a star pattern with multiple dojis in the middle, that's fine. I can live with that. Because all they're doing with the dojis is they're just basically trying to trap more people. But you want this part up here, this part here of that second leg, you want it to be a railroad track, a star pattern. You don't get a lot of quarter woods up here, but you want it to be within 45 minutes. Because if not, they're just going to go higher and higher and higher and higher, and that just defeats the whole purpose.